My name is Dedan, your all-time financial advisor. Welcome back again. In this video, I will explain derivatives in a very simple way, using real-life examples so that you can understand. No big finance terms, no confusion, just how they work and why investors trade them. I understand most of you understand about shares or treasury bonds and treasury bills, but derivatives may be a new concept. We'll start by explaining what are derivatives. A derivative is a financial contract that derives its value from the performance of another underlying asset. Those assets can either be commodities, stocks, or market index. We will focus more on the derivatives deriving their value from the performance of stock or shares. We have four main types of derivatives. The first one is options, swaps, forwards, and futures. Today we are going to focus more on futures. Remember, you can trade futures in the Nairobi Securities Exchange. I will try to simplify futures as much as possible so that you can understand, so that you can have a clear picture of what futures are. A future is an agreement between two people to buy a particular asset at a predetermined price at a specified time in future. In simple terms, a future is just a promise. Future is just a promise between two people. The first person agrees to buy something, and the other person agrees to sell it. They sit down today and set a price of a transaction that will happen in future. But the actual exchange will happen at a future date. Let us use a very simple example. Imagine you agree to buy a bag of maize at 3,000 Kenyan shillings after 3 months. No matter the price after 3 months, either higher or lower, both of you must stick to the agreed price. Even if the price of maize after 3 months will be 5,000, you will buy at the agreed price. This agreement is called futures contract. The price is set today. Buying or selling happens in the future. Both parties must honor the agreement. Let me use a real example of a person who has succeeded in trading futures. That is Richard Dennis, who was a trader in the 1970s. He was a trader in the US commodities market. He borrowed around 1,600 US dollars and began trading futures contract. That is predicting price movements in the commodities. In 1974, he made about 500,000 US dollars profit from trading soybean futures alone. The derivatives provides more options. You can make a profit even when the share price drops. When investing in shares, you buy shares expecting the price to go up so that you can make profit. What about when the price drops? Let us assume that you have bought cooperative shares, which is around 29 shillings. You buy expecting the price to go up, maybe to 35, so that you can make profit. What if the price drops to 20 Kenyan shillings? What will happen? You'll make a loss. But in the stock market, you only make a loss when you have sold your shares. With derivatives, you can still make a profit even when the price drops. This is how you can make profit even when the prices drops. In derivatives, you can choose to go long or to go short. Going long means buying. When you buy, you expect the price to increase. And going short means selling. When you sell, you expect the price to go down. Futures contracts allows you to hedge your portfolio. Hedging is a strategy that investors use to try and minimize the losses on their portfolio. And let us see how you can hedge using futures contracts. Let us assume that you own shares, maybe KCB, Cooperative, ABSA, or any other stock you own in the spot market. When you realize that the price is falling, you can go short in the futures market so that the losses that you make in the spot market are offset by the gains that you make in the futures market, and by that you'll not have made any loss or any profit. The loss and the profit will balance. We will have several practical examples in part 2 so that you can understand better and have a clear picture of how you can hedge in the futures market. In futures market, you can trade on margins. Margins means that you need to deposit a small amount of the total value of the shares. You don't need to have the full amount. If you want to trade, let us use an example. If you want to trade 10,000 shares of cooperative shares on the futures market, which is currently trading at 29 shillings, you just need to have a small margin, and this will enable you to have a higher purchasing power. Using a small margin, you have a higher purchasing power. Leverage allows you to trade a large value of shares using a fraction of the total cost, and that is all about margin. In the futures market, if the trade happens today, settlement will take place tomorrow. While in the spot market, if the trade happens today, settlement will take place after 3 days. Futures contracts are available in the 10 key NSE stocks, which are KCB, Cooperative, NCBA, INM, Standard Chartered, ABSA, Safaricom, EABL, BAT. You can trade futures contract online in the NSE market. You just need to have a broker that has an online trading platform. Futures contracts are traded in the Nairobi Securities Exchange market, which is called NEXT, which is regulated by the Capital Market Authority. Trading in margin is a bit risky, and this is why. Margin can magnify your profits, and also they can magnify your losses. If the trade goes against your prediction, if the trade goes according to your prediction, you make a very huge profit. And if it goes against your prediction, you make very huge losses. Derivatives are a bit complex, and that is why they are not commonly traded. You need to learn and understand very well about derivatives so that you can start trading. I will work with you until you understand everything that you need to understand and get started. See you in the next video as we discuss practical examples in the futures market.